I want to welcome you to Financial Training for Business Owners. Today, we'll focus on the factors that affect your cost of goods sold. We're going to review 6 factors that destroy your business's ability to make money. Now, as we previously explained, there are only 3 numbers that you really need to focus on in any P&L statement. They're the ones highlighted in red: revenue, COGS, and overhead. The reason these 3 are so important has to do with the simple fact that these 3 are the only numbers in your P&L that you can directly impact. The remaining 4 numbers are all determined by these 3. You find gross profit by subtracting COGS from revenue, and then dividing that number by the revenue gives you the gross profit percent. When you subtract your overhead from your gross profit, you find your net profit, which you then divide by revenue to determine your net profit percentage. So the 3 numbers you can directly impact, and the ones we're going to focus on to help you make dramatic financial gains with zero cost, are revenue, COGS, and overhead. We then discuss the power of exponential growth. In this example, if we could impact these 3 areas by 5% each, meaning we increase our revenue by a meager 5% and lower our COGS and overhead by 5%, we would generate an additional $27,000 in net profit, and at zero cost. So now that begs the question, how can we increase revenue and lower our COGS and overhead? Well, the good news is there are multiple ways to impact each of these 3 areas. So today, let's focus solely on the best ways to lower our cost of goods sold. This is an extremely important area to really delve into. Why? Because both revenue and COGS directly impact your gross profit. And your gross profit pays your overhead and is responsible for generating profit in your business. But before we discuss ways to lower COGS, we need to understand and examine the factors that directly affect it. Once we make you aware of these damaging factors, we can then show you various ways to overcome them. Well, factor number 1 involves misunderstood pricing. I want you to consider this example. Let's say you sell widgets, and to build each widget costs you $100 in material plus $75 in labor. So your cost of goods sold equals $175 per widget. Now, you decide you want to make 35% profit on each widget you sell. So you multiply your $175 cost times 1.35, which equals a price of $236.25. This is how most business owners set their product or service pricing. But is this the correct way to do this? Well, let's not guess. Let's plug our numbers into our P&L template and verify our numbers. Our price of $236.25 is the revenue each widget will generate. And we know it costs us $175 to build each one, so that's our COGS. We subtract our COGS from our revenue, and we get our gross profit of $61.35. Now, is $61.35 really 35% of gross profit? Well, remember our formula for determining our gross profit percentage? That's to divide our gross profit by our revenue. So when we divide $61.35 by $236.25, we find our gross profit percentage is only 26%, not 35%. This means you're only generating about 75% of the profit you were targeting. Now, obviously, our original formula where we multiply our COGS by 1.35 is wrong. What's the correct way to determine a 35% profit margin? Well, you must use the inverse to calculate this properly. To find the inverse, you simply take whatever profit margin you're targeting and subtract it from 1. 1 minus 0.35 equals 0.65. So our new formula for determining our price is to take our $175 COGS and divide it by 0.65, which equals $269.23. Now, is that the right number? Well, let's plug it into our P&L and find out. Our new price of $269.23 is the revenue each widget will generate. And of course, it still costs us $175 to build each one, so that remains our COGS. We subtract our COGS from our revenue, and we get our new gross profit of $94.23. Now, is that figure 35% of gross profit? Let's plug into our formula and find out. We divide 94.23 by 269.23, and we find our gross profit percentage is now 35%, just what we were targeting. Be sure you double check your pricing for all of your products and services to ensure you're generating your desired profit margins. Let's move on to the second factor that can directly impact COGS, discounting. Most small business owners often discount their price in the mistaken belief they will sell more stuff and make more money. What actually happens is they often end up destroying their profit margins. Yes, they often do sell more stuff by discounting, but the few additional sales they make typically fails to make up for the lost profit. Depending on your margin, if you discount your price by a mere 10%, you now have to sell 50% more, and that's just to break even. If you sell a widget for $100 and you have a 30% profit margin, you end up making $30 for every widget you sell. That means your cost of goods sold for that widget is $70. If you then discount that widget 10% and sell it for $90 instead of $100, your COGS is still $70. At this point, you're only making $20 in profit instead of your original $30. You now have to sell 50% more widgets just to get back to your original profit margin.
Run the numbers. You would only need to sell 100 widgets at your original $30 profit margin to make $3,000 in profit. But you would have to sell 150 widgets at your discounted $20 margin to realize $3,000 in profit. Seriously, stop and think about that for a minute. For a measly 10% discount, you now have to sell 50% more just to break even. Now, do you really think a 10% discount will ever result in a 50% increase in sales? And here's the kicker. When was the last time you saw someone offer only a 10% discount? Most businesses offer 25 to 40% discounts. They are literally destroying their margins, if they even have any margins at those discounted rates. However, there is some good news. This process works in reverse as well. If you increase the price of that widget by 10% and sell it for $110, your COGS is still $70. But now you're making $40 in profit instead of $30. That's a whopping 33% increase in profit with just a 10% price increase. The key to increasing your price without losing customers is to build more value into your offer. Prospects shop value, not price. Offer 4 times more value than your competition, and you can easily double your price. The problem is most competing businesses all offer the exact same value, so price becomes the only differentiating factor. Now, our third factor that can directly impact COGS has to do with supplier price increases. Typically, once or twice every year, suppliers raise their prices, often to cover their own supplier price increases. It may be small incremental increases that most business owners might not realize have even taken place. 2 to 5% annual increases are common, and many business owners just shrug these off as no big deal. Well, in reality, these are huge deals when it comes to your bottom line. Let's look at the effect of a 5% supplier price increase on our widget company. Let's bring up their P&L. A supplier price increase will show up in COGS, so our revenue remains the same at $300,000. Now, let's assume we experience a supplier price increase that increases our COGS by just 5%. Our COGS grows from $180,000 to $189,000. That in turn lowers our gross profit from $120,000 to $111,000. That lowers our gross profit percentage from 40% to 37%, which is a whopping 9.3% decrease. Our overhead doesn't change, it remains at $60,000, but our net profit drops from $60,000 to $51,000, a jaw-dropping 15% decrease. That measly 5% supplier increase has impacted our company's bottom line by 15%. This demonstrates perfectly the major impact small cost increases can have on the profits of small business owners. So the question is, how well do you monitor your supplier invoices? You may not notice 2%, 3%, maybe 5% increases, but as you can see, they can have a dramatic impact on the profitability of your business. But there are 3 additional factors to take into account when monitoring your COGS. Warranty and returns need to be carefully monitored. Do you have defective product coming back for replacement or refunds? The returns may have nothing to do with your business or your processes. It may be due to defects from your suppliers, but it's your bottom line being impacted. This obviously increases your material cost. You paid the labor cost to build the original widget, and now you have to pay the labor cost again to replace it. That duplicate labor could have been redirected to making additional widgets, so now you're experiencing what we refer to as an opportunity cost. Scrap is another factor to watch. Scrap has the same cost impact as returns. It increases your material, labor, and opportunity cost. The third factor to watch is your inventory. If you overproduce in anticipation of increased sales and those sales fail to materialize, you end up with excess inventory. Often, excess inventory is stored randomly wherever room happens to be available. Keeping track of what's available and where can be tough if the business doesn't have a proper inventory tracking process. But the bottom line is this: returns, scrap, and inventory can easily impact your COGS by 10% or more. So let's check out the damage to our bottom line if we experience a 10% increase in COGS. Let's again bring up the P&L for our widget company. Our revenue remains the same at $300,000. Let's increase our COGS by 10%, so we go from $180,000 to $198,000. That in turn lowers our gross profit from $120,000 to $102,000. Our gross profit percentage plunges from 40% to 34%, which is a massive 15% decrease. Our bills, they're our bills, so overhead stays at $60,000, but our net profit tanks from $60,000 to $42,000. That's a jaw-dropping 30% decrease. That's a 30% profit decrease on a 10% cost increase. Again, this example demonstrates the major impact small cost increases can have on the profits of small business owners. So the question again is, how well are you monitoring your cost? So to recap, these are the 6 areas to consider when looking to reduce your COGS. Misunderstood pricing, discounting, supplier price increases, warranty and returns, scrap, and excess inventory. I hope this session has made you vitally aware of the financial damage small cost increases can have on the profitability of your business. Next up, we'll show you how you can address these 6 deadly factors and in the process dramatically lower your cost of goods sold. This will have a major impact on the profitability of your business. So until then, here's to your success.